Welcome back. It's October 12th, and we had quite a sell-off on Friday. I made a video the following Monday, about 6 days ago, and I went over the fact that I was scaling back on some of my positions because I felt the market was a little frothy. I was a week early. I kind of got that sell-off that I've been looking to deploy more capital in. So here we can see the S&P. On Friday, we had a pretty precipitous drop right at 10:30 in the morning and pretty much went straight down up until the close. And then if we look at the volatility index, you can see the opposite, a huge jump up. When VIX gets in the 20s, this is where I'm looking to deploy a little bit more capital. So let's go to my positions. And you can see my netlick is 61,607. I'm still profitable. My cost basis is $60,000 in this account, and I've been going for almost 2 months now. So I'm still up 1,600 bucks. I was up 3,400 dollars before the big dip there. I'm still profitable. I didn't panic sell anything. I'm still going strong with the strategy. I'm happy that I took my foot off the gas pedal. You might ask, well, why didn't you just pull everything off? And that way you didn't have to experience any type of pullback in your net lick. Well, I would say that I don't have a crystal ball. And just because the markets were frothy doesn't mean that they were going to dip. It just so happened to play out that way. It could have very easily kept going for another month, 2 months, 3 months, a year. I don't know. But statistically, if you look at a chart, you can kind of see when markets, they run them up to sell them off, to run them up again. And that's Wall Street's way of running them up to take profits and then buying it once it crashes a little bit or once the market comes down, they buy it back and they run it back up to sell it off all over again. With that concept in mind, that was my idea. Like I said, I don't know when the market's going to dip. I can just tell it's getting frothy. So I wanted to trim back. I still had exposure. So if the market kept going up, I would have kept making money and growed with the market. And now I'm in a situation where I have more capital to deploy, even though I'm going to take assignment of some of these shares. So I sold an SOXL put that expired on Friday at the 40 strike, and I was assigned at the close. It was at 34.21. So I'm down quite a bit on that, but I'm not realizing a loss. So when I say I'm down in value, an unrealized loss, but I do not have a realized loss because I'm going to go ahead and sell the 40 strike covered call and I'm going to pull that up so we can look at the prices. With the wheel trade, once I'm assigned, now I'm going to start selling covered calls. So it looks like I can collect 48 bucks for 5 days. So we'll do the math on that real quick. So about $9 in theta per day. And if I was to annualize that, that's a pretty nice return, assuming I could get that type of premium on a consistent basis. But I just wanted to show that as a percentage. And so my cost basis being $4,000 on this position, that's an 86% return. Point of all this, what I'm saying is just because the market dips doesn't mean I'm going to panic, doesn't mean I'm going to have to accept a loss. I'm just going to write a covered call and then I'm going to sell another put. So let's go into because I want to take advantage of this spike in implied volatility, I'm probably going to go out 33 days. And you can see I can collect huge premiums. I mean, $300, $400 for the 34 put. On Thursday, the 34 put was probably trading for 100 bucks. Now I can collect $400. And the only difference is, there's a huge difference in price now, and implied volatility has skyrocketed. So I can collect more premium for the same amount of risk that I would have taken last week. Hence why I pulled back on the positions. Now I got more money to deploy. I'm going to go ahead and probably sell the 30 put, collect 250 bucks on 33 days. So let's do the math on that. That's about $7.50 a day. of premium. I'm also going to wait for TQQQ to expire, assuming that this market doesn't recover in time for that expiration, which would be this upcoming Friday. If I get assigned the shares, fantastic. I'll sell a covered call. Let's just see if I were to get assigned. I got the 102 put. It's trading at 97. So the 102 put would pay $166 for 5 days. Not bad at all. And then if I were to deploy another put, I can collect between $200 to $700. Again, these puts on Thursday, the 97 was probably trading at a few $100s, maybe $300, $400. Now you can get a lot more for it because it's closer to the at the money. You got the spike in implied volatility. And that's why I like to keep capital on the sidelines to deploy. So my overall message for this market dip is if there's products out there that I've wanted to buy, now is the time to get them on a nice discount. I don't look at the market dip as a panic event. I look at it as a fire sale. I hope this helps. Take care and God bless.